We are here today talking about our recent sale of Alibaba, which was an investment that we have only held for a little less than 2 years. So wanted to get together to talk about that investment and debrief why we bought it, what we held it for, and then why we recently made the decision to sell it. So Pete, given that you were the man behind the idea here in terms of sourcing Alibaba, why don't we start with your background on Alibaba and how we came to know of it and what the thesis was?
Okay. In early March of 2023, Dominic sent me an email saying that there was a company called Penza Value that has a number of funds. And he said in that article, they had their best ideas for the year. And it was the first time we had seen anyone choose Bank of Ireland as one of their investments. So we were kind of surprised in that. So I listened to the link, and I realized that it was much more to the program than just the Bank of Ireland. So I listened to the whole program, and in there, at the time, Chinese stocks across the board had been hit very hard. And one of the mentions was Alibaba, which was a company I was familiar with. So the company was actually the stock had declined from its high of about $350 a share, was trading just about near its IPO price of $68 that it had reached 10 years earlier. But during that period, their revenues had gone from 12 billion to 145 billion. Their profits had gone from 3.9 billion to about 25 billion. They had tremendous free cash flow. They had a lot of cash. They were aggressively repurchasing their stock. So there was a lot of potential things that if a number of little things went right, we would be in good shape. Subsequent to our purchase, literally within a few months, the company continued to aggressively buy back their stock. They announced a cash dividend of $1. They announced a bonus dividend of $1. And the Chinese government, much like happens in the United States, decided to put in some economic incentives for businesses. And so we had appreciation of the company rather quickly. One of the interesting things actually was we felt that they had a tremendous opportunity in data centers and in artificial intelligence, much like a number of the US tech companies do as well. But for whatever reason, all that was being ignored. And over the subsequent year and a half, those things have unfolded, and we've seen the stock price more than double. And normally our investment intention is that we want to see an investment double over a 5-year period, not over a 2-year period. But as they've gotten more and more into artificial intelligence and the stock price has risen, the management team seems to agree with us. Stock repurchases has come to a screeching halt, and they're investing very, very heavily into building out the data centers and their artificial intelligence. And their positive cash flow, which was in the $20 billion area, has gone the opposite direction. And so moving forward, it's not as attractive in our opinion, given that the stock price has risen significantly and our free cash flows have pretty much dried up. So we're hoping that we see other values, and so we're just taking money off the table because we feel it's very close to being fully valued. Tom, anything you'd like to add?
No, not too much. The entire Chinese market was getting hit, just like over fears, basically, that the U.S. would delist some of the Chinese securities, and Alibaba was at the forefront of that. And so I think a lot of the bet was we were betting on a cheap stock with a lot of political uncertainty that if either one started to improve, we were buying a stock at single-digit earnings multiple, and there was a lot of opportunity given where U.S. stocks were trading that had this e-commerce AI tech business compared to where Alibaba was trading at.
So Dom, I remember our original meeting around Alibaba, and I think at first you were quite skeptical, right? Given, hey, this is a Chinese business, they're, but less transparent than U.S. Businesses, and I guess like despite that, we came to the group decision to make an investment here, right? But talk to me about like where your head was at when we first looked at it, and then like what you've come to learn through the process here.
Sure. Yeah. The other part of owning Alibaba is you don't exactly own the Alibaba stock. You own some like offshoot of the security. And so there was other concerns that, hey, is the Chinese government just going to like basically take over Alibaba and basically just leave minority U.S. shareholders as just like you guys get nothing, we'll take the assets. I think when I guess where I came out is the U.S. and China are so interrelated that we were getting to a point where I remember Howard Marks saying at like the great financial crisis, he kept saying like, oh, well, what if it's worse? Like, what if the credit losses are worse than, the worst year or 10% worse than the worst year? And it's like, what was getting priced into Alibaba was just so much pessimism surrounding I'm gonna say not so much the business, but just so much the political narrative around it that when you looked at the underlying business, it was a very healthy business. They had minority stakes in several different assets, really healthy balance sheet. And I guess when one tide of the boat goes to such one side with one narrative that you don't need much to go right, should that narrative ever change. I think those concerns around the Chinese government are still there. They're just, it's something that ebbs and flows over time. And right now we're at one where things seem okay. I'm sure again in the future things will flare up again. But when you have such a narrative to one side and a cheap asset, it's made it a little more feasible and interesting to buy it.
This past weekend, I finished the book Breakneck, Dan Wang's book on China's quest to engineer the future. The Chinese government has an enormous amount of power, and so those political concerns continue to exist. It's just that we no longer had an investment that looked to be in the bargain basement area, and also we have significant holdings in other areas that are artificial intelligence related, and so we're comfortable adding to our cash position. So, we've had some experience with where companies go with tremendous free cash flows to suddenly having negative cash flows, and a good example of that was Intel, and as Dom and I discussed it, Dom said, we're literally going from a company that's producing 20 billion in free cash to negative cash, and we have no idea when that's going to stop. That are the management's decision to do that realistic? And we said we love free cash, and we're not interested in the business going to significantly negative free cash because it brings on an element of risk that we don't want to take. So we do have some kind of history of following this same pattern in the past, and that obviously worked out very well for us. Although we did take a 10 or 15% loss on Intel, but then we also didn't have to suffer through the additional 25-point decline that it ultimately had.
Right. So I look at Alibaba as a great example of kind of our go anywhere, any market capitalization, no geographic restriction, kind of quasi growth stock. But like we definitely saw that it was deeply discounted. Pete, I don't know if you mentioned it earlier. I might have missed it, that we were buying this company at basically the same price it had IPO'd at 10 years prior, but everything had risen by a factor of fivefold during the 10 years in between. But this is one of those great examples of like, hey, we might own a $1 billion company or a $60 billion or a $100 billion company. So maybe just talk about that and like where are you going to look for value and how is that always changing? And like, but for both of you, because I think your processes there's a lot of consistency there, but there's also some very, unique things that each of you do to find these great investments over the course of a year. So Pete, why don't you go first?
Sure. I love one of the quotes by Howard Marks, and he says, we don't find great investments, they find us. And so you don't necessarily know where those areas are, but in areas where there are things that you can look at that look to be that this is an area that is more attractive, and it's usually an area that has been beaten down for one reason or another. And probably the area that jumps out at me to the greatest extent, and it has been for a while, is small cap and mid cap companies relative to large cap. Large cap companies are, in the most part, are trading at very high ratios of some of the things we look at: the price to earnings, price to book value, the price to growth, and other areas, and the dividends that they're returning. So the area that looks attractive now would be, in my opinion, the small or medium-sized companies. And you can see that where we've added to a number of companies like 5 Point Holdings and Tri Point Homes and other businesses like that. So it's also real estate related or home building related that are where we see the most attractive area at the moment, or at least that's where I think is very attractive. Don, what are some of your thoughts?
Yeah, I think when you spend all day reading and listening, things just start to come together. And it's not just one piece of news from the Wall Street Journal or Barron's. It's you listen to a company's report, they start talking about one thing, you go listen to others, and you start to paint basically like a mosaic picture of, hey, here's the areas that companies say are doing really well. Here's the areas that are maybe slower. And then the areas that are slower, typically that's where you're going to find some sort of cheaper asset because nobody wants to buy a business that is not performing up to its normalized level. Then you go out and you start researching those companies. And again, it's not one data point, it's not one company, but it's more of a marriage of all of the different things that we read and listen to that you get a sense of, hey, this could be a good idea if things get back to normal levels. And I think, as you said, on the housing, that's kind of where we are today. Nobody wants to own anything housing, lumber related, because all they see is interest rates are higher than where they were a couple of years ago. But the sun rises and the dust settles at some point, and you can't find good, cheap assets that everything is going perfectly for. So it's sifting through the noise to get there in the end.
Well, one of the other things that I think is like a good thing to talk about and capture here on this call is, Pete, you mentioned earlier that the original idea came from a report that you listened to. Pazina had put out a report, and you were listening to it because of the Bank of Ireland position that we mutually owned. But then you came across this. Can you guys talk to how, like, just common, I know how common it is, but just talk to how common it is for us to find other ideas that, whether they be like-minded investors or just really thoughtful people, have written and talked about, and that's how we came to initially know of an investment. And then from that point, what do we do to build our own thesis off of it and make it a position in the portfolio if that's what it ultimately becomes?
It is wonderful as you're reading through those, as Dominic mentioned, you don't necessarily know where it's going to come from, but you see something that looks like it's attractive, and then it gives you the opportunity to research it further. So we didn't read the report and they saw Alibaba. We then went and started digging into Alibaba and listening to the reports and spending some time saying, indeed, is what Penza is saying, is that accurate? And is that something that we're comfortable doing? And everything pointed to if this was not a Chinese company, we would love to own it. So our major hangup was owning a Chinese company, which we had never owned before. And the Chinese government, especially as I've seen from my readings of Breakneck, there's a trust element there that is a very valid scenario, and it's a risk that are you comfortable handling? And so we made the decision that in this case it was worth handling, but by no means has this gone away, and the relationships with U.S. and China. I'm not sure I answered your question, so I'll let Dominic maybe get focused on answering the question as you asked it.
Yeah, I mean, I read a bunch of quarterly investor letters every, typically they come out in like January, April, just on the quarterly cadence. And I go in there just first seeing what people are writing about, and then sometimes there'll be significant overlap between maybe the industry that they're all writing about. From there, that's sort of just like the starting point. It's on us to then go out and, one, verify what they're saying is true, and then two, do our own due diligence on the name. Coming across an interesting idea on paper versus having your own internal conviction are two totally different things. And so while we like the idea of Alibaba from Pazina, it's, hey, we need to go out and actually confirm everything that they're seeing and also come up with our own thesis, because relying on somebody else, you're going to be like one of the last people to know if something's going against you. So it's start with potentially somebody else's idea, do our own internal process, and then come out of it with our own conviction in either buying it or not buying it.
Well, one of the great sources that I see is I read through the Wall Street Journal, and I call them like red flags that go up. I see a red flag on whether it be the momentum of artificial intelligence stocks, or what's going on with a various business. So those, after a while, a bunch of red flags come up, and the red flag can be a positive or negative red flag. But when you read through the Wall Street Journal, I'm looking for 2 or 3 interesting ideas or things to take note of each time I'm reading the Wall Street Journal. I can't absorb hundreds of things, but I can take 4 or 5 things each time I read the journal and things. And then it starts, like Dominic has said, it starts leading you in a direction that starts making sense for you, that this is something that we should spend more time with. And as you spend more time with it, you then start realizing that this is something that's attractive, or that it's something to stay away from.
Why don't we just wrap up with like your final thoughts on how Alibaba worked out, what you liked about it, what you didn't like about it, and what we gleaned from this learning experience that we'll incorporate into future investment decisions that we make.
I'd say that it's obviously a very positive outcome. We bought something that was very inexpensive at the time that is now considerably more expensive. And there's we have a significant amount of money in cash, but it's hard right now to try to find a large cap company that is unloved and unwanted, and it is a really, really healthy company. So we're willing to walk away from the situation if we believe that it's overvalued, and stay with cash. And in the case of artificial intelligence, we still own a very large position in Corning. We have position in NVIDIA, Qualcomm, and other companies that have potential scenario with our potential interest in artificial intelligence and stuff. So we're comfortable letting a piece of that go.
mean, I think the thesis by and large played out how we wanted it to. The thing that changed is the profitability and the free cash flow generation of the company. And the bet is not the same when a company you're paying whatever it was, $100 billion, couple $100 billion for a company trading at a single digit free cash flow versus now you've got a company that's burning cash. And so the bet is now, are those reinvestments into the company good reinvestments versus before it was got a great business, a lot of cash, keep purchasing shares and dividend out excess cash. I don't think those two bets are the same. And the AI portion of the story is still in the early innings. I think thus far there's getting more traction on that side of, hey, Alibaba is a potentially large winner from that. They're now spending like they need to. And then on the Chinese front, again, things have de-escalated a little. So like the two major points that we were looking at, I think played out pretty well.
Well, guys, thanks for blocking off some time to talk through this one. We'll keep doing this. I think it's helpful to debrief our investments as we sell them. Obviously, you can't give people a heads up on when we're buying things, but after the fact, after we've gone full cycle on something, I think it's helpful to talk through what the whole process was. So thanks for your time today.
Awesome.
Thank you.
Thanks, Justin. Thanks, Pete.